Good afternoon, investors and corporate. Welcome to SET Digital Roadshow Year-End 2022 Performance Review. This session will run about 45 minutes, including Q&A. Company will start the session by 30-minute presentation, followed by 15-minute Q&A. During Q&A, investor may leave your question in meeting room chat box or use raise your hand function. We will open your microphone so you can ask the question to the company directly. May I now invite Thai Oil Public Company Limited to start the presentation.
Thank you, and hello investors. Welcome to Thai Oil's SET Digital Roadshow for the fiscal year 2022 performance presentation. First, let me introduce our management joining the presentation today. First is Khun Nathapol Naparatwong. He's our Vice President of Commercial Planning. Second is Khun Chiriyon Rienglunrom. She's a Manager Investor Relations. And myself, Thosang Chaprawat. I'm a Vice President of Financial Planning. There are three agendas today to cover, including the key highlights, performance analysis, and market outlook. Let me start with the key highlights. Okay, on the first page, in 2022, there were three key factors impacting Thai Oil performance last year. First is the ongoing Russia-Ukraine conflict, which has caused tightening of both crude and product supply in the market in the first half of 2022. Second is the high inflation, leading to aggressive interest rate hikes by many central banks to control the inflation, which consequently caused a slowdown in economic growth and recession concerns in the second half of last year. Third is a recovering global oil demand from economic reopening as COVID-19 situation eases, and gas oil and gasoline demand have already recovered to the pre-COVID level, while the jet demand continues to rise following increasing international flights. We expect jet demand to recover back to pre-COVID level by early next year. In addition, higher demand and tight supply in the product market has caused oil inventories globally to drop below 5-year average level. As a result, crude prices rose more than $100 per barrel first half last year and dropped back to $77 per barrel in the second half, while the Singapore gross refinery margin averaged over $10 per barrel from sharp rise in the product crack spread last year. For the key performance highlights, market GRM, the gross refinery margin last year rose to $12 per barrel from only $2.2 per barrel in 2021 from higher crack spreads on all products, in line with the growing economic activities and tight product supply situation. With over $5 increase in the crude oil price, loss was reported at 37.6 billion Thai baht. In terms of the net profit contribution, 95% of our net profit come from refinery and lube business, 3% from power and 2% from other businesses. On the strategy side, we have solid progress on our 3V's strategy to transform our business portfolio to become a sustainable energy and chemical company. For our first strategy, volume maximization, our key project, Greenfield project, progress at the end of 2022 was at 90%. This year, we will focus to complete the construction on site to be ready for commissioning and testing next year. We expect the commercial operation date to be in the first quarter of 2025. For our second most important investment is on the Chandra RC investment. Last year, we implemented several business integrations initiatives, including the production integration and the sales and marketing integration. We also supported CAP on the CAP2 project development as well. For our second strategy, value enhancement, we have repositioning the top solvent to be top next and changing the business model to integrate and expand the sales and marketing to capture more market shares in 3 targeted countries, including Indonesia, Vietnam, and India. We also collaborate with PTT under Project One to maximize synergy in 4 key areas, including crude procurement, product export, chartering, and hedging. And for our third strategy, value diversification, we focus on the power business. We have a top SPP, power plant expansion is on track and is ready to be commercial operation in April this year. For the new business, we have dual approach. The first approach is investing in new startup via CVC, and the second approach is development and higher value business, which we currently studying on two key areas. The first one is on the bio business area, and the second is on the new energy, which we are now studying the green hydrogen and carbon capture business. And last but not least, last year, Thai Oil was rated number 1 in the world for 2022 DJSI oil and gas refining and marketing industry. For the 7th time that we are number 1, and we have been listed as a member of DJSI for 10 consecutive years. This demonstrates our commitment and recognition for sustainable business operation to ensure a sustainable growth for the company in the future. So this covered the key highlights in 2022 for Thai Oil. Next part is a financial analysis by Kun Chiriyon ค่ะ
Thank you for the presentation. Next, I will go through finance analysis part, covering Q4 and full year of 2022 results on each business unit, and a bit cover on the financial statement and the capex. First, I will start with refinery business. In terms of utilization rate on the top left corner, in Q4, we had slightly lower intake to 103% because of planned maintenance of CDU number 2 with capacity 50 KBD. But if you compare with the industry run rate, our run rate is still higher than the industry average at 80%. And for full year 2022, our refinery utilization rate increased to 107%, up from 100% in 2021. And you can see that it's back to the pre-COVID level in 2019. It was mainly supported by the coupling domestic oil demand. As you can see on the right hand side, you can see that total domestic oil demand increased year on year 16%, led by jet demand 87% up year on year, and the diesel 16% higher year on year. And the gas or gasoline demand increased almost 4% year on year. And in terms of commercial, last year we captured strong domestic sales, 85%, and export 15%, which was mainly sales to our neighboring countries, CRB, Cambodia, Laos, and Vietnam. Total around 11%. We export to other countries under 4%. And in terms of our customer, our number 1 customer is PTT. Around 46% of total petroleum products was sold to PTT, and 38% sold to other domestic customers such as PTT, and around 7% sold to other major oil, Shell, Chevron, and Bangja. And on the next page, in terms of gross refinery margin or GRM, in Q4, we reported market GRM $9.3 per barrel, improved from $6.7 per barrel in Q2, mainly supported by lower crude premium and improving middle distillate spread Q-on-Q. And for full year 2022, our market GRM significantly improved to $12 per barrel, mainly supported by improving global oil demand, so product inventory for one. And in terms of crude oil prices, as crude oil prices continuously decline in Q4 from the concern over the economic recession, the Dubai price went down Q on Q. Together with the lower crude premium, like Melbourne premium, lower Q on Q as well. So in Q4, we had a good stop loss, $9.7 per barrel, or approximately 9.2 billion Thai baht. However, for full year's picture, crude oil prices slightly increased year on year. So we record stock gain around $1 per barrel for full year 2022, or approximately 3.6 billion Thai baht. So if we combine the market GRM stop loss, so in Q4 we reported accounting GRM minus $0.3 per barrel. It's still higher Q on Q from minus $2.9 per barrel in Q3. And for full year 2022, we reported accounting GRM $13 per barrel, up from $6.9 per barrel in 2021. And moving on to aromatics business. In terms of aromatic production, we had relatively low aromatics production, 67% in Q4 and 71% in 2022. It's lower both Q on Q and year on year due to the softening aromatics spread, pressured by the additional capacity mainly from China. And for the LAB production, it's remained high at 117% and 118% in Q4 and for full year 2022 respectively. And in terms of the aromatics and LAB contribution, in Q4, we had improving aromatics and LAB contribution, $0.8 per barrel, consisting of aromatic contribution $0.2 and the LAB contribution $0.6 per barrel. And for full year, the aromatics and LAB contribution was softer year on year from $1.7 per barrel to $0.4 per barrel, consisting of the aromatics contribution is a negative $0.3 per barrel and LAB contribution around $0.7 per barrel. And last business unit, the lube business. In terms of lube production, our lube production was lower to 43% in Q4 and 77% for full year 2022, as we had 1 month plant maintenance in October. So the lube utilization went down from the normal operation rate at above 85%. And similarly, the contribution from lube business was lower to $1 per barrel in Q4 and $1.1 per barrel for full year 2022, mainly from the plant maintenance, as I mentioned earlier, and coupled with the softening lube base margins, which pressured by the lower base oil demand due to the concern over economic slowdown. And on the next page, in terms of margin and cost, on the left-hand side, in terms of GRM, I mentioned earlier, it shows in the top chart, we reported $9.3 per barrel market GRM and minus $0.3 accounting GRM. And for full years, we reported $12 per barrel market GRM and $13 per barrel for accounting GRM. If you look at in terms of gross integrated margin or GIM in the below chart, in Q4, we reported market GIM $11.1 per barrel or $1.5 per barrel accounting GIM. And for full year 2022, we reported market GIM $13.4 per barrel and the accounting GIM, $14.3 per barrel. And on the right-hand side, in terms of the cost, I would say that we still maintain our cash cost at a competitive level. And for the refinery operating cost, you will see that we can maintain that below $2 per barrel. And in terms of the group cash cost, in Q4, the cash cost is a seasonal high to $3.1 per barrel. It's mainly from higher operating costs, $2.3 per barrel, while the interest expense is remain unchanged around $0.8 per barrel. And for full years 2022, our group cash cost was $2.8 per barrel. And on the next page, for the olefins business, we as you may know that we invest in Chandra Asri or CAP in 2021. We invest through our subsidiary Top Investment Indonesia or TII. And last year we reported net loss from olefin business, $23 million due to the softening petrochemical spread, mainly from weak demand in China. And next business unit, for the power business, I would say that for power business unit, this is kind of the stable income for Thai Oil Group. And last year we had a net profit from power business around 1.4 billion baht, consisting of the contribution from our own power plant, top SPP, around 1.3 billion baht. Is higher year on year. And another contribution from GPSC around 114 million baht. It shows lower year on year due to the higher in the gas and coal prices, and coupled with because we had a lower percentage in holding in GPSC, as last year we sold 10.78% holding to PTT. So right now we hold GPSC around lower to around 10%. And on the next page, in terms of performance breakdown, I have mentioned for the main business unit, refinery, petchem, lube, and power. And for other contribution from other business, it shows numbers is lower year on year, mainly from both solvent and ethanol business. For solvent last year, we had lower net profit due to the loss on some accounting item, which is the forex loss. But in terms of the overall solvent market, it's still favorable. And for the ethanol business, contribution last year was lower year on year, as last year we don't have the one-time gain on the reclassification from UBE like in 2021. And next page, in terms of the P&L, I will quickly recap for this page. We reported the EBITDA, improving EBITDA 37 billion baht, as well as increasing in net profit, as Khun Thapsang mentioned earlier, 32.7 billion baht, or equivalent earnings per share 15.63 baht per share. It's mainly from the stronger in the refinery margins. And on the next page, in terms of cash flow, last year we had a beginning cash and the short-term investment 30 billion baht, and and last year we had higher in operating cash flow 43 billion baht, which is mainly from the improving in net profit. And while the investing cash flow was around 9 billion baht, it's mainly from CapEx spending around 32 billion baht. And mostly offset with the cash inflow from GPSC share sales around 22 billion baht. So the free cash flow last year shows around 34 billion baht. And we net with the cash flow from the financial activity around 20 billion baht. So in 2022, we had ending cash, including short-term investment, around 43.9 billion baht. And moving on to the financial position, we ended last year 2022 with the total asset 444 billion baht. It's increased by 22% from the end of 2021. It's mainly from higher current assets following rising crude oil prices and higher fixed assets from the CLP project. And for liability, we had higher accounting payable from higher crude oil prices, and for the interest-bearing debt, it's decreased year on year from loan and bond repayment. And speaking of that, the end of last year, we had a net debt position, $3.8 billion. It was mainly the US currency, around 71%, and the rest 29% is Thai baht currency. And in terms of interest, we had the interest mainly was fixed around 82%, and the rest 18% was the float rate. And in terms of the cost of debt, we have a cost of debt around 4% net interest income base. And looking at the key financial ratios, as Khun Thaksan mentioned earlier, end of last year, we had a net debt per EBITDA lower to 3.5 times. It's improved year on year from higher EBITDA and the debt repayment. While the gearing ratios, net debt per equity is lower as well from 1.2 times. It's lower to 0.8 times, mainly from our success of the recapitalization plan, consisting of the GPSC share sales and the equity offering. We use the proceeds from our recap plan to repay the bridging loan. And in terms of the credit rating, I would say that all of credit rating reaffirm our rating at above investment grade. And last year, Moody's announced to change the outlook from negative outlook to stable outlook, reflecting the positive view on Thai oil, on our good in terms of refinery margins, and in terms of our stronger in our financial profile. And next, in terms of the CapEx plan, last year, 2022, we utilized the CapEx around $842 million, and most spending was the CFP project around $746 million. And for the CapEx for the next 3 years, the total was around $991 US, mainly belong to the CP projects, around $563 million. And another key spending is for the olefin investment, $270 million US. And the remaining CapEx, around $170 million, is mainly for our infrastructure improvement project and for our subsidiary expansion project. And I think that's cover all for the performance analysis part. Next, I will hand the session over to Khun Thapon for the market outlook.
Thank you. And the last part is the market outlook. I'll cover the crude oil market, refinery, petchem, and base oil. The first one, let me start out with the crude oil market. This year, we see oil price to move around $80 per barrel. And during the first half of the year, we might see some headwinds, but the second half, the market could recover a little bit on the tightening demand supply balance. If you look at the demand first, we see a positive demand outlook in the East, mainly from China's reopening policy. So there'll be some pent-up demand in this region. But in the West, because of the high inflation and also increasing interest rate, there could be some pressure on the Western markets. But if we look at overall demand growth in this year, a lot of institutions has been revising up their oil demand forecast. So in the past, moving around 1.5 million barrel a day this year compared to last year. But some of them actually raised the forecast up to 2 million barrel per day this year because of the Chinese demand recovery. And the next slide on the supply. We see that the supply loss from Russia could be quite limited. If you see that during the first quarter this year, after the ban of the European imports, Russian producer can still export to other countries. So we think that they can actually maintain the export, but the ban on product could affect some refinery runs in the country. So as a crude oil production in overall, we think that the supply could be lower by about 1 million barrel per day from the normal level. And other production, we do see that the OPEC members will need to maintain their cuts. During the Q4 last year, they announced to cut the production quotas by 2 million barrel per day because of the oversupply situation. And going forward, at least until the first half of the year, we think that they need to maintain that cuts because of the limited supply loss from Russia. And see during the second half of the year, if demand recovers, we should see that they can actually rewind their production cut later on. If we look at the supply-demand balance for the crude oil market on the right-hand side, you can see that during the first half of the year, we should have some surplus in the market, and there is some the inventory build to be expected. But the second half of the year, the market could be more balanced. So the oil price outlook, first half could be a little bit of pressure, but the second half could improve a little bit. And then let me move on to the margin side. Refining margin last year was quite exceptional. Singapore cracking margin averaged almost $11 per barrel. During the first quarter to date this year, it's still moving around $8 per barrel. So you can see that it's still much above the pre-COVID level, around like $5 to $6 per barrel, thanks to the demand recovery as well. So the gasoline demand has been quite strong, and the middle distillate, which is jet and diesel, also improving back to the pre-COVID level because of the Chinese reopening policy. Let me show you some figures on the next following slides. The first one on the supply and demand balance for the refinery markets. This year, 2023, you can see that there will be some capacity to be online. Net capacity growth could be about 1.6 million barrel per day in this region, which is balanced with the demand growth that we see. And most of the capacity would be ramped up during the second half of the year. So the current market during Q1, Q2, the product side could still be quite tight, but the second half if the ramp up is successful, then the market could be slightly softer. And then let me show you some figures on each key product. Let me start with the gasoline market. You can see that the gasoline demand is moving around pre-COVID level, and we expect the strong demand during the summer driving season this year. And the main growth of the gasoline will come from Asian market because of the Chinese reopening again. And China export could continue to drop from the peak that we saw in fourth quarter last year. Now demand in the country is recovering, so they can cut export to the region, and that will support crack spread for the gasoline. On the right hand side, jet market, you can see that the global commercial flight is coming back to 2019 level, and we see increasing demand in this region, particularly in China and Asia. So global jet demand will move back to the pre-COVID level sometime late this year or early next year. Next, the gas oil market. The demand is still moving around 2019 level as well, and we do expect the demand to maintain quite strong. Inventory level is still at a very low level, continue from last year because of the tight supply market. And this year we also have some impact of the Russian supply after the EU banned imports from February. So now Russia needs to export their diesel or gas oil to other countries. In total, we expect gas oil production and export could be lower by 200 to 300,000 barrels a day, and that will support the market a little bit. But some pressure also remains in the market because the Chinese export for gas oil is still quite elevated at the moment. In first half of the year, continue to be at a very high level from Q4 last year. But during the second half, the export could be lower because of the demand improving. Then the fuel oil market is demand is quite firm, so we see a higher demand compared to pre-COVID level because of the demand for power generation and also bunker fuels. And for export, if the Russia need to cut their runs, the refinery runs, then the fuel oil export could be lower as well, and that could support the fuel oil market going forward. So in overall for refinery market, we think that the GRM could be lower from last year, which was quite exceptional, but still much better than the normal level that we saw prior to the COVID situation. And then let me move on to the petrochemicals market in the next few slides. Let me start with aromatics, where we have PX and benzene production. This sector continue to be under the pressure situation because of the supply overhang in the market. So you can see that during the past 4 to 5 years, the capacity addition was quite massive, and demand growth could remain quite stable. But because of the supply overhang, the utilization rate of the aromatics plant in the region and also in the global market could be quite under pressure at the moment. But going forward into 24-25, we do see that the wave of the capacity will start to end, and then the demand growth will start to absorb the surplus in the market. But if we compare this year to last year, actually the spread has been improving or recovering compared to the lows that we saw last year because of the demand recovery in the region, and also the lower oil price also support the margin for downstream businesses. And then let me move on to the olefins. Similar to aromatics, on both PE and PP. During the past 3-4 years, the market's been oversupplied because of the new capacities, and utilization rate will remain quite low level until 25 as well. But again, this year compared to last year, we do see some improvement because of last year the lowest one was in Q4. A lot of plants shut down because of the weak margins, but now the market is improving. So we see that the worst was over, but the market on the upside could continue to be quite capped. And the last one is base oil market. So we are the base oil group 1 producers, and some of the group 2 productions can be used as a group 1 as well. So you can see that in 2023 there will be some group 2 and group 3 capacity to be online, and group 1 typically demand is slowing down, so some plants could be closed in some regions. So the market for group 1 could be penetrated from group 2. But this year, because the fuel oil price is still quite low compared to diesel, so fuel oil is about $10 to $15 per barrel, lower than Dubai, but diesel is 20 or more premium to Dubai. So if we look at that dynamics, the fuel oil, which is the feedstock for group 1, and diesel, the feedstock for group 2, we do see less pressure from that group 2 because they have less competitiveness because of the higher feedstock costs. So you can see the spread between base oil and fuel oil in the dotted line. This year, although it's lower from 2022 and 2021, but still quite healthy compared to the pre-COVID level. So I think that concludes the presentation. So the crude oil market average, we expect around $80 per barrel. First half softer, second half slightly better. Refinery market normalizing from last year, but still higher than pre-COVID level. The downstream petchem and base oil are quite challenging because of the new supply, but the worst could be quite over compared to like Q4 last year. Base oil may be slightly softer this year, but still at a healthy level compared to the normal level that we had in the past. And that concludes the presentation. Let me pass on to the Q&A session, please.
Okay, if no further questions, thank you very much for attending our 2022 performance presentation, and we look forward to meeting you again as our next presentation this year. Thank you very much.
Thank you.
Thank you.